time. Let's dive into the essentials of chart analysis, a key element in unlocking the secrets of successful trading. Imagine being able to read a chart and immediately grasp what the market is telling you. This skill is crucial for making smart decisions and managing your risk. First, let's talk about the different types of charts you'll encounter. Line charts are straightforward, connecting closing prices over a period and giving you a clear view of the overall trend. When you need to see the big picture, line charts make it easy to spot whether the price is generally moving up, down, or staying flat. Bar charts offer more detail. Each bar shows you the open, high, low, and close prices for a specific period. This gives you a fuller understanding of how the price moved throughout that time, making it easier to see where the market has been and where it might go next. Candlestick charts take it a step further by adding visual depth with their body and wick structures. Each candlestick tells a story, whether the price went up or down during the period and how volatile the trading was. Green or white candles typically indicate upward movement, while red or black candles suggest a drop in price. Now let's move on to the key components of these charts. The x-axis represents time, showing how prices have evolved over minutes, hours, days, or even weeks. The y-axis displays the price, letting you track the asset's value at each interval. Together, they provide a complete picture of market behavior, helping you predict future movements. Don't overlook volume. Is where you see the number of shares traded during a period. High volume can confirm a price trend, signaling strong interest and making the trend more reliable. Low volume, on the other hand, might suggest that the trend lacks conviction and could be weaker. Indicators are another powerful tool in your analysis. Moving averages smooth out price data, allowing you to see the trend without getting caught up in daily fluctuations. Bollinger Bands show you the range of price movement, giving you insight into volatility and potential breakouts. These indicators, when combined, offer a richer, more nuanced understanding of market dynamics. Reading charts effectively starts with spotting trends. An uptrend characterized by higher highs and higher lows indicates a rising market. A downtrend marked by lower highs and lower lows suggests prices are falling. Sideways trends, where the price moves within a horizontal range, show indecision in the market, which can be challenging but also full of opportunities if you know what to look for. Support and resistance levels are your guides in these trends. Support is where prices tend to stop falling as buyers step in. Resistance is where prices often stop rising as sellers begin to dominate. Identifying these levels helps you decide when to enter or exit trades, ensuring you make moves at the right time. Chart patterns are your roadmap to predicting future movements. The head and shoulders pattern can signal a reversal from an uptrend to a downtrend, giving you a heads up that the market might be about to change direction. Double tops and bottoms are also key reversal signals, while flag patterns suggest that a trend is likely to continue. Now, when it comes to executing trades, stop-loss market orders are essential for managing risk. They automatically sell your asset when it reaches a predetermined price, limiting your losses and protecting your capital. Market limit orders help you optimize entries and exits by executing trades at your specified price or better. For even more control, stop limit orders combine both stop and limit orders, ensuring your trades occur within a set price range. This strategy is particularly useful when you want to avoid selling at a price lower than you're comfortable with, especially in volatile markets. As you apply these techniques, think about how you can customize your charts to fit your trading style. Whether you're focused on short-term gains or long-term investments, tailoring your charts to highlight the most relevant data helps you stay organized and focused, making your analysis more effective. Take these tools, techniques, and insights and integrate them into your trading routine. By doing so, you'll be better equipped to navigate the market, manage your risks, and make informed decisions that align with your financial goals. Let's dive into why chart analysis is so important. For traders, charts are indispensable tools because they provide a clear, visual representation of how prices move over time. This visual aspect is crucial. It allows you to see patterns and trends that might not be obvious from just looking at numbers. By analyzing these charts, you can spot whether the market is trending up, down, or sideways, and you can use that information to predict where prices might go next. Chart analysis helps you move beyond guesswork and base your decisions on concrete data. When you can identify trends, you're better equipped to decide when to buy, sell, or hold an asset. It's all about timing. Knowing when to enter and exit the market is key to successful trading, and charts give you the insights you need to make those decisions with confidence. Whether you're tracking the overall market direction or honing in on specific price movements, charts are your guide to making informed and strategic trading choices. Let's explore the different types of stock market charts, starting with the simplest line charts. Line charts are straightforward, connecting the closing prices over a specific period to form a continuous line. This simplicity makes them ideal for quickly spotting trends. For example, if you pull up a line chart of a stock over the past year, you'll immediately see the general direction the stock has been moving, whether it's trending upward, downward, or moving sideways. The beauty of line charts lies in their ability to strip away the noise, giving you a clear view of the overall trend without getting bogged down by daily fluctuations. This makes them a great tool for identifying long-term patterns and making broad assessments of where a stock might be headed. Bar charts offer a more detailed look at price movements, providing a comprehensive view of market activity over a specific period. Each bar on the chart represents the open, high, low, and close prices, giving you a fuller picture of how the price has fluctuated within that time frame. This detailed perspective is particularly valuable when you're trying to understand the volatility of a stock. By examining the length of the bars and the range between the high and low prices, you can quickly gauge how much the price has been swinging within a given period. A tall bar indicates significant movement, suggesting high volatility, while shorter bars reflect more stable price action. Bar charts are also useful for identifying potential support and resistance levels. By seeing where the price tends to open and close consistently, you can start to spot patterns that might indicate future price behavior. This makes bar charts a powerful tool for traders who need to analyze price movements in depth and make informed predictions about where the market might be headed next. Candlestick charts take the level of detail a step further, offering not just the data, but also a visual insight into market sentiment. Each candlestick displays the same key information as a bar chart: open, high, low, and close prices, but it does so in a format that's more intuitive and easier to interpret at a glance. The body of the candlestick represents the range between the opening and closing prices. If the candle is green or white, it usually means the price went up during that period, closing higher than it opened. Conversely, if the candle is red or black, it indicates that the price fell, closing lower than it opened. The wicks or shadows extending from the top and bottom of the body show the highest and lowest prices reached during the period. These elements together provide a quick snapshot of market sentiment, whether buyers or sellers were in control, how volatile the trading was, and where potential reversals might occur. Candlestick charts are especially useful for spotting patterns that indicate future price movements, such as bullish or bearish trends, and for understanding the strength or weakness of those trends. By reading these charts, you gain a deeper understanding of the market's mood and can make more informed trading decisions based on the visual cues they provide. Understanding the key components of stock market charts is essential for effective analysis. The x-axis plays a fundamental role by representing time. It shows the intervals at which the data is recorded, which can range from minutes and hours to days or even weeks, depending on the type of chart you're using. This axis helps you track the progression of price movements over your chosen period, allowing you to see how events unfold in the market. The y-axis, on the other hand, represents the price. It displays how the price of an asset has changed over time, letting you see the highs, lows, and closing prices within each interval. By looking at how the price interacts with time on these axes, you can better understand market trends, identify potential turning points, and make more informed trading decisions. This relationship between the x-axis and y-axis provides the foundation for all chart analysis, helping you visualize market behavior and anticipate future price movements. Candlesticks and bars are powerful tools that represent price movements within a specific period, offering valuable insights into the market's behavior. For instance, a single candlestick might correspond to one full day of trading, encapsulating the open, high, low, and close prices for that day. The length of the candlestick's body is particularly telling. It shows the difference between the opening and closing prices. A long body suggests a strong price movement in one direction, indicating that the day was marked by significant buying or selling pressure. A shorter body, on the other hand, suggests that the price stayed relatively stable, with less intense movement from the market participants. The wicks or shadows, extending from the top and bottom of the body, indicate the highest and lowest prices reached during that period. Long wicks suggest that the price fluctuated widely, indicating volatility, even if it eventually settled near its open or close. Shorter wicks indicate that the price remained close to the opening and closing prices, signaling a more stable trading session. By analyzing the length and position of the body and wicks, you can gain a deeper understanding of the day's price action, whether the market was volatile or stable, and whether buyers or sellers had the upper hand. This level of detail helps you anticipate future movements and make more informed trading decisions. Volume is a critical component in chart analysis, providing insight into the level of market activity during a specific period. It represents the number of shares traded and serves as a strong indicator of the market's interest in a particular stock. When you see high volume accompanying a price movement, it often confirms the strength of that trend. For example, if a stock's price is rising on high volume, it suggests that many traders are buying into the trend, indicating strong interest and increasing the likelihood that the trend will continue. This kind of volume confirmation gives you more confidence in the validity of the price movement. Conversely, low volume during a price movement might suggest that the trend lacks strong support from the market. If a stock's price is rising or falling on low volume, it could indicate weak interest, making the trend less reliable and potentially more susceptible to reversal. Low volume can be a warning sign that the current price movement may not have the momentum to sustain itself. Understanding volume alongside price action helps you gauge the strength of a trend, confirm potential breakouts or reversals, and make more informed decisions about when to enter or exit a trade. Indicators are essential tools that enhance your ability to analyze market momentum and make informed trading decisions. Two widely used indicators are moving averages and the Relative Strength Index, or RSI. Moving averages are particularly useful because they smooth out price data over a specific period, making it easier to identify the overall trend. By averaging the prices over a set number of days, moving averages help you see the direction the market is heading without getting distracted by short-term fluctuations. This clarity allows you to determine whether the market is in an uptrend, downtrend, or moving sideways, which is crucial for timing your trades effectively. The RSI, on the other hand, measures the speed and change of price movements. It operates on a scale from 0 to 100, helping you gauge whether a stock is overbought or oversold. When the RSI rises above 70, it suggests that the stock might be overbought and due for a correction. Conversely, if the RSI falls below 30, it indicates that the stock could be oversold and might be poised for a rebound. This makes the RSI a valuable tool for spotting potential reversals and adjusting your strategy accordingly. By incorporating indicators like moving averages and the RSI into your analysis, you gain a deeper understanding of market momentum, helping you to make smarter, more informed trading decisions. Now, let's focus on how to read stock charts practically, starting with identifying trends, which are the foundation of chart analysis. The first thing to look for on a chart is the trend, as it reveals the market's overall direction. An uptrend is easy to spot, characterized by a series of higher highs and higher lows. This pattern means the price is generally increasing over time, indicating that buyers are in control, pushing the market upwards. In an uptrend, each peak is higher than the last, and each dip still finds support at a higher level than the previous one. This steady climb is a positive signal for those looking to buy or hold a position. On the other hand, a downtrend shows a sequence of lower highs and lower lows. This pattern indicates that the price is decreasing over time, suggesting that sellers are dominating the market. In a downtrend, each rally fails to reach the previous high, and each decline pushes the price to new lows. This is typically a signal to be cautious, as the market is losing value. Sideways trends, also known as consolidation, occur when the price moves within a horizontal range with consistent highs and lows. In this scenario, the market lacks a clear direction, as neither buyers nor sellers have the upper hand. Sideways trends can be challenging to trade because the price oscillates within a narrow range, making it difficult to predict the next move. However, they can also present opportunities for traders who anticipate a breakout in either direction. By identifying these trends, you can better understand the market's current state and make more informed decisions about when to enter or exit trades. Whether the market is trending up, down, or sideways, recognizing the trend is your first step in chart analysis. Support and resistance levels are crucial for making informed trading decisions. These levels act as psychological barriers in the market, where price movements often pause or reverse. Support levels are the points on a chart where prices tend to stop falling. This happens because at these levels, there's strong buying interest. Traders see value at this lower price, and as they start buying, the price finds a floor and begins to rise. Recognizing support levels is essential because they can indicate a good entry point for buying, as the price is more likely to bounce back from these levels. On the other side, resistance levels are where prices tend to stop rising. Here, strong selling interest comes into play as traders start to take profits, preventing the price from going higher. When the price approaches a resistance level, it often struggles to break through, which can be a signal that it's time to consider selling or taking profits. If the price does manage to break through a resistance level, it might indicate a strong uptrend with further gains ahead. By identifying these support and resistance levels on your charts, you can make more strategic decisions about when to enter or exit trades. These levels act as guideposts, helping you anticipate potential turning points in the market and ensuring that your trades are timed to take advantage of price movements effectively. Patterns in charts are powerful tools for predicting future price movements. Recognizing these patterns can give you an edge in anticipating what the market might do next. One key pattern to watch for is the head and shoulders. This pattern often signals a reversal from an uptrend to a downtrend. It's characterized by three peaks, a higher peak in the middle, the head, flanked by two lower peaks, the shoulders. When you see this pattern forming, it often indicates that the market's upward momentum is weakening and a downward move could be on the horizon. Double tops and double bottoms are also important patterns that suggest potential reversals. A double top occurs when the price hits a high point twice but fails to break through, indicating that the market might be losing steam and could reverse downward. Conversely, a double bottom happens when the price hits a low point twice without breaking lower, suggesting that the market might be finding support and could start to rise. Flags are another useful pattern to recognize. They typically indicate a continuation of the current trend. A flag forms after a strong price movement, followed by a period of consolidation that creates a small, flag-like shape on the chart. If you see a flag in an uptrend, it usually suggests that the market will continue to move higher once the consolidation period ends. The same applies in a downtrend, where a flag might indicate that the downward movement is likely to continue. By recognizing these patterns, head and shoulders, double tops and bottoms, and flags, you can better anticipate market shifts and position yourself strategically, whether you're preparing for a reversal or riding a trend continuation. Using a stop-loss market order is an effective way to manage risk and protect your investment. This type of order automatically sells your stock when it reaches a predetermined price, ensuring that your losses are limited. For instance, if you purchase a stock at $100, you might set a stop loss at $90. By doing this, you ensure that if the stock's price drops to $90, your position will be sold automatically. This means that your loss is capped at $10 per share, preventing further losses if the market continues to decline. To set a stop-loss order in RTrader Pro, simply select your stock, choose the stop-loss order option from the menu, and enter your trigger price. This straightforward step helps you maintain control over your trades and keep your losses within acceptable limits, making stop-loss orders an essential tool for any trader looking to manage risk effectively. Market limit orders are another crucial tool in a trader's arsenal. These orders allow you to execute a trade at a specific price or better, giving you control over the price at which your trade is executed. For example, if you're looking to buy a stock but only want to do so if the price is $50 or lower, you can set a market limit order with that price. This ensures that your order will only be filled if the stock is available at $50 or below, preventing you from paying more than you're comfortable with. Similarly, if you want to sell a stock, you can set a limit order to ensure that you don't sell for less than your target price. Market limit orders are especially useful in volatile markets where prices can change rapidly. By setting a clear price limit, you ensure that your trades align with your strategy and that you're getting the best possible price for your entry or exit points. This kind of control helps you optimize your trading outcomes and avoid unwanted surprises. Stop limit orders offer a more precise approach to trading by combining the features of both stop and limit orders, allowing you to execute trades within a set price range. This provides you with greater control over how and when your trade is executed. For instance, let's say you own a stock and want to sell it if the price drops to $48, but you don't want to sell for less than $47.50. You can set a stop limit order with a stop price of $48 and a limit price of $47.50. If the stock's price falls to $48, your order is triggered. However, it will only be executed if the price stays within your specified range, ensuring that you don't sell for less than you're willing to accept. This strategy is particularly useful in volatile markets, where prices can move quickly and unpredictably. A stop limit order helps you avoid selling at a price lower than you're comfortable with while still protecting your position if the market starts to decline. By setting both a stop and a limit, you gain more control over your trade execution, ensuring that your trades occur within the price boundaries that you've determined. Here are some tips for enhancing your chart analysis and making your trading more effective. First, when setting stop-loss levels, consider placing them just below support levels. This approach helps you avoid triggering your stop-loss due to small, temporary price drops that don't signal a real trend reversal. By positioning your stop-loss strategically, you protect your trades from unnecessary exits while still safeguarding your capital. Market limit orders are another powerful tool to optimize your trade entries and exits. They allow you to execute trades at prices that align with your strategy, ensuring that you're buying or selling at the levels you've carefully planned. Combining stop limit orders with chart patterns can create a robust trading strategy. For instance, if you identify a head and shoulders pattern classic reversal signal, you can set a stop limit order to sell if the price drops below the neckline. This approach minimizes your losses by exiting the trade at the right moment, while also positioning you to maximize gains if the pattern plays out as expected. Finally, take the time to customize your chart layouts to highlight the most relevant data for your trading style. Whether you're focused on specific indicators, time frames, or price levels, tailoring your charts to your needs helps you stay focused on the information that matters most. This customization streamlines your analysis and ensures that you're always working with the data that's most important to your strategy. By applying these tips, you can refine your chart analysis, improve your trade execution, and build a stronger, more effective trading strategy. Our Trader Pro is a powerful platform that offers everything you need for in-depth chart analysis. With its advanced charting tools and real-time data, you can conduct thorough and precise market analysis. The platform makes it easy to set up and customize your charts, allowing you to tailor them to your specific trading needs. You can start by selecting from a variety of chart types, whether you prefer line, bar, or candlestick charts, each offering different insights into price movements. Adjusting the time frames is straightforward, whether you're focusing on short-term trades or analyzing long-term trends. This flexibility ensures that your charts are always aligned with your trading strategy. Our Trader Pro also allows you to add a range of indicators to your charts, such as moving averages, Bollinger Bands, or volume analysis tools. These indicators enhance your analysis by providing deeper insights into market trends, volatility, and potential entry or exit points. The platform's user-friendly design means you can easily customize your chart layouts, ensuring that the most relevant data is front and center. This customization helps you stay focused on the key information that drives your trading decisions, making RTrader Pro an invaluable tool for any serious trader looking to refine their strategies and improve their results. As we wrap up, let's quickly review the key points we've covered today. We started by exploring the different types of stock market charts, like line charts, bar charts, and candlestick charts, each offering unique ways to visualize price movements. Understanding the key components of these charts, such as the x-axis for time and the y-axis for price, is crucial for effective analysis. We also delved into essential order types, including stop-loss orders to manage risk, market limit orders to control entry and exit prices, and stop limit orders that provide more precision by combining the features of stop and limit orders. It's important to validate chart patterns such as head and shoulders, double tops and bottoms, and flags with volume to ensure they're reliable signals. Additionally, using multiple indicators in your analysis can help confirm trends and improve the accuracy of your predictions. Remember, the key to becoming a successful trader lies in continuous practice and refinement. Keep applying these techniques, stay disciplined in your analysis, and always look for ways to improve your strategies. This ongoing effort will sharpen your trading skills and help you navigate the market with greater confidence and success. As you consider applying these tips and techniques to your trading, think about which features you're most excited to explore. Are you eager to experiment with different chart types like candlestick or bar charts to gain deeper insights into price movements? Or perhaps you're interested in integrating multiple indicators to enhance your analysis and spot trends with greater accuracy. Think about how you can customize your charts to fit your specific trading style. If you're a short-term trader, you might focus on intraday charts and set up real-time alerts for significant price movements. For longer-term strategies, you could adjust your charts to highlight weekly trends and incorporate indicators that align with your investment goals. The key is to tailor your chart setup so that it aligns perfectly with your trading strategy, making it easier for you to focus on the information that matters most. By customizing your charts, you can streamline your analysis, make quicker decisions, and ultimately improve your trading performance. So, as you move forward, consider how these tools and techniques can be integrated into your routine to help you achieve your trading objectives. Thank you for joining us today. We hope this tutorial has been helpful and that you feel more confident using stock market charts. Keep learning, keep trading, and see you next